Introducing Ausbiz Capital GrowWise, a new fund which combines institutional insight and experience with a target return of 15% per annum. Our fund mirrors SciTech GrowWise, backed by an 18-year track record with historical 21% average annual net return. With more than $1.45 billion under management, the SciTech GrowWise Fund is led by award-winning global portfolio manager Ivan Sherman. The same strategy is now available to Australian investors from as little as $5,000. Discover Ausbiz Capital GrowWise, investing informed by experience.
This program is brought to you by LGT Crestone, local private wealth expertise backed by the stability of a global presence.
Hello, this is The Global View on a Wednesday. I'm Andrew Gagan. Thanks for joining us here again at Ausbiz. Let's get across what we've seen on global markets overnight. Mostly lower, while US Treasury yields hit their highest level in more than a month as the impact of tariffs showed up in the latest US inflation data. Now on Wall Street, the focus was on quarterly results from the big banks which kicked off earnings season. While those results failed to spark investor buying on the Dow, there was excitement on the Nasdaq as it posted another record driven by Nvidia, the AI chip leader, gaining after revealing plans to resume sales of its H20 AI chip to China as part of US negotiations on rare earths. Nvidia had forecast the curbs to selling in China would have cut its revenue by around $15 billion. And that news buoyed other chip makers, with Advanced Micro Devices and Supermicro Computer both gaining. Now, banking stocks whipsawed in volatile trade. JP Morgan Chase slipping despite raising its net interest income outlook, while Wells Fargo fell heavily even as its profit rose on reduced loan loss reserves. BlackRock hitting a new milestone for assets under management, yet its shares also falling. However, Citigroup climbed to its highest since the global financial crisis after its traders delivered a windfall that boosted its second quarter profit. Well, rising prices across an array of goods pushed US inflation higher in June, in what economists see as evidence of increased import taxes in the form of tariffs being passed through to consumers. Overall, consumer prices rose 0.33% in June at an annual rate of 3.5% after rising 0.1% the previous month. Core inflation increased at a 2.9% annual rate, with food and energy costs both increasing, pushing the headline rate up to 2.7%. In response to that inflation data, FOMC member Thomas Barkin said you've got suppliers who are emboldened by the inflationary experience and know they're having cost pressures and feel empowered to try to pass it on. And you've got consumers who are exhausted by inflation who are already trading down. While fellow Fed member Susan Collins said she expects the Fed's preferred gauge of underlying inflation will likely be in the vicinity of 3% by year's end before resuming its decline. Well, US Treasury yields rose to their highest level in a month off the back of that data, while interest rate futures reflected growing uncertainty that the Fed would resume rate cuts in September. The 10-year yield gaining more than 6 basis points to 4.48%. The 2-year rose to 3.96%. And the US dollar index jumped more than 0.5%, reaching a 15-week high against the yen, the Aussie having fallen back to 65.2 US cents. And Bitcoin pulled back after scaling new highs to be trading at just under 118,000 US dollars. And in the latest development on the trade front, President Trump says he's reached a deal with Indonesia that will see it face a tariff of 19% on its exports to the US, while US exports will not be taxed. Indonesia has also reportedly agreed to purchase $15 billion in US energy, as well as agricultural products and around 50 Boeing jets. And US President Donald Trump says he will impose a tariff on pharmaceuticals by the end of the month, before ramping it up over a year or so. Last week, he's flagged that medicine exports to the US could face duties of up to 200%. Well, let's catch up with what's going on. Commodities, oil prices falling after President Trump gave Russia a 50-day deadline to end the war in Ukraine and avoid sanctions. Brent crude futures down more than 0.5% at $68 a barrel. Copper rose marginally. Iron ore fell almost 1% to $98 a tonne. and gold easing as those treasury yields and the dollar rose. Spot gold at around $3,320 an ounce. Well, let's turn to the US, and with a focus on those bank earnings. To get across them, I caught up with Ken Leon from CFRA Research.
Certainly what a difference a quarter makes. And what we saw for the banks is confirmation that not only the US economy, but global economies are still fairly stable and growing. That was indicative of the total loan growth, total deposit growth. The US consumer, particularly related to credit cards, did show mid-single digit growth. So that's really kind of Main Street economy. Capital markets, mostly positive, although a little bit mixed. We had record revenue fee income from debt underwriting, mergers and acquisitions picked up. Equity underwriting still is not where it should be, and we're expecting it in the second half of this year. The last really driver for performance for these banks, particularly banks like Bank of America, JP Morgan Chase, Bank of New York Mellon, is net interest income. It's 65% of total revenue. And with the point about having a healthy economy, we did see loan volume increases. So even with rates flat to down, what that means is net interest income grew, which was surprising. Overall, there's still risk as it relates to the trade tariff picture. Also, the health of the consumer, particularly those that are in income levels, not at the upper end. So banks did well today. You have to keep in mind, and we're positive on the banks, and we have an overweighting on the financial sector, is that they had very strong performance in the second quarter. So we had a little bit pullback today in the stocks.
Yeah, interesting to see that pullback. But so, Ken, I guess there's optimism there about investment banking, particularly given that deal making essentially rebounded in the second quarter there. But that's also balanced, I guess, with the broader look at what we're seeing in the economy, and particularly the effect of tariffs.
So it was interesting because all the banks that did report, not only my estimates, but I think the consensus raised meaningfully revenue and earnings for 2025 and 2026. That means that when you have stocks that have really performed well and valuations are extended, we like to call it where you earn into those multiples, so that they almost, for targets that were raised on 2026 earnings, you're almost at a 3 or 5 year average on, let's say, PE multiples or other benchmarks.
Just taking a look at investment banking, the fees for the JP Morgan there, higher than guidance. Citigroup reporting a 15% increase in investment banking revenue.
There's still more to come here because when you look at investment banking, the areas of equity underwriting benefit when the financial sponsors, the private equity firms, begin to off-ramp those owned companies that are 5-7 years in the fund. We haven't had that for 2 years, and it's $2 trillion that either needs to come to the public markets as equity or M&A, or they stay in terms of financial sponsors within private banks. Many instances there, these banks that reported today benefit as agents for those kind of transactions.
What are we seeing on the mergers and acquisitions front, and how that's affecting the banks at the moment?
Well, we really, I'm a global research director, so we began to see M&A pick up in outside the U.S., that being in Europe. We've seen it more in region so far, not cross-border transactions. And during the second quarter, it began to pick up in late May into June. Will that continue into the third and fourth quarter? We think so. Keep in mind for these banks, even investment banking, it's an important driver, but they have some other stable, large businesses that are showing healthy mid to upper single digit growth. asset management, wealth management, treasury services. All of these are very stable and predictable, and I think they lend themselves to have confidence either in the earnings outlook or having, a higher target price.
Yeah, in fact, Citigroup, the chief executive there, saying that its M&A pipeline looking excellent. Was that perhaps the reason why we saw Citigroup's obviously share price jumped higher, whereas the others fell?
I think so. They also have kind of a delta of more improvement because they've lagged in the last 2 or 3 years. The stock has also been trading at a discount to net tangible book value. The rest of the banks are at really hefty premiums. So finally, we have a target price on Citi with a buy that is now above book value, which is amazing, looking back over the years I've covered Citigroup since 2008.
All right. Look, on the downside, Wells Fargo, they're cutting its net interest income forecast, so its shares did actually fall quite sharply.
Yeah, we saw that. And again, it's really the flywheels of their different businesses. And Wells Fargo doesn't get the benefit of net interest income from, if you will, the brokerage or wealth management areas as much as, traditional banking for middle market corporate loans. So, I think overall, the good thing is for Wells Fargo, and we have a buy in it, is that they're no longer under the restraint of a consent decree from the federal government or Federal Reserve. So now they can begin to grow their balance sheet. So I think the question you're asking was actually threw off the market or maybe the analysts that they were guiding lower net interest income than before. The other banks did not.
So, Ken, you've got a buy on Wells Fargo. What's your rating on those other banks that have reported?
So we have a hold on JP Morgan Chase, and we would prefer to wait for some pullback before getting back into it. Bank of New York Mellon is also a buy recommendation. And for tomorrow, we're really excited because we have our investment view of the driver for earnings growth is the capital markets with Goldman Sachs strong buy, Morgan Stanley buy, and then we have Bank of America, kind of more like JP Morgan. We have a hold on the stock.
Ken Leon from CFRA Research. Let's return to our local market. We are expecting a lower open, so SPI futures off around 0.75%. Stay with us. We're going to get across all of that in just a minute or two.
This program was brought to you by LGT Crestone, local private wealth expertise backed by the stability of a global presence.